But of course, want to take a look at the market action as that volatility is continuing on this Thursday morning. You can see the Dow Jones Industrial Average down 1%, the S&P 500 down 0.6%. But take a look at the NASDAQ actually squeaking out a positive day, up about 0.25%. But as I mentioned, the volatility broadly, when you measure it just in terms of the VIX index, also known as a fear index, up to 31, Akiko. So even though markets are mixed right now, the open actually looked a little bit ugly. People seem to be a little bit concerned.
Yeah, and the real focus over the last 24 hours, I would say, has really been on the American consumer. Yesterday at this time, we were talking about Target falling in a big way. We heard from Walmart. Today, we've heard from other retailers as well. And the concern here is that prices are increasing at such a rapid rate, and consumers are shifting their habits on that front, too. If you take a look at some of these names that we saw yesterday, remember, it was red across the board on that
Deep
front.
red. Yeah.
Target still falling today, obviously not at the rate we were seeing yesterday, but those declines continuing. And worth looking at some of these other names that we heard from today, including Kohl's as well as Canada Goose, some of those retail names not as significant, or I should say not as big in size as a Target or Walmart, but a good gauge for us to be looking at there as well.
Yeah, also interesting to see BJ's Wholesale Club. This was a stock that was down over 10% yesterday. Again, they didn't report earnings yesterday. They reported earnings today. They seem to be getting a bounce back of about 8%. I'm not sure if that's recovered all the losses on a two-day basis. It looks like actually not doing necessarily all that bad. But one interesting point is just to kind of take a big step back, because we've seen some rapid market movements over individual trading sessions. But when we just look at the S&P 500, if we take a look at a year-to-date basis, it has been an ugly 2022 when you consider that we're down about 18% year-to-date. Bear market generally understood to be about 20%. So for anyone that was buying in as of New Year's, hasn't been a good year at all for them.
Well, and the underlying fear in all of this, right, is that the Fed moves too quickly and does not manage a soft landing, a hard landing, obviously being that there is a recession. We've had 1 quarter of contraction, but that seems to continue to be the concern here. And that's why we've been watching the consumer really closely to see, well, what exactly are some of the habits that have been shifting? Another thing we're watching today is, of course, gas prices, as we see that hit $4.59 in terms of the national average. And now we see all 50 states hitting above $4 a gallon in terms of the average there. We're always kind of watching California because they are one of the highest. That state is now above $6. And we got that warning yesterday from JP Morgan saying that California price could be the national price come August, just given because gas inventories are still so low.
Yeah, and what was interesting was that I feel like in the first, let's say, 2 to 3 months of this year, the whole conversation was really all about energy, right? In fact, if anything, it was energy that was the main winner in terms of equity plays and investment strategies. And when you take a look, for example, just the XLE, the Energy Select Spider Fund, when you're looking at a year-to-date basis, I mean, that index is up 45%, while the S&P 500 at large has been down 18%. So the oil space has certainly been a good, successful investment strategy through the short term. But you do kind of wonder, the supply story has been so volatile through the beginning of this year. You do wonder about whether or not the oil prices that we're at right now, when you take a look at the barrel of crude oil, will honestly stick around just because of how noisy it is. The Russia-Ukraine situation still remaining very much in the headlines.
Well, and the lockdowns in China as well, with concerns around demand on that front. You know, worth noting, Brian, if you bring it back to where the markets are, we've seen so many, we've seen significant declines here. But when you look at where the declines have been, obviously yesterday we saw very broad-based declines, but 8 companies representing nearly 50% of the losses on the S&P 500. And these are the names that we talk about a lot. It's Microsoft, it's Apple, it's Facebook, Netflix, Nvidia. Those stocks have declined significantly and making up more than nearly 50% of the losses.
We know that tech stocks have been battered throughout this whole thing. I mean, when you take a look at the losses compared to the S&P 500, you're like, well, maybe the S&P 500 doesn't look so bad compared to some of these big tech stocks, which people through the pandemic recovery thought were essentially ironclad. But what we're seeing now is, I think, the fear of just an overall economic picture. We'll talk about that later on in the show. But today's action makes that a little bit more curious, because every day that we've seen a down day has often coincided with a more accelerated sell-off in the NASDAQ, in those large tech stocks, than in the broader market. So when I'm taking a look at the Dow Jones, at least this morning, again, don't want to read too much into one morning's worth of movement, but the Dow down 300 points, but the NASDAQ actually in the positive, you're starting to wonder if the tech stock story is beginning to change a little bit. I'm not going to try to get into the minds of investors, but certainly worth watching. Of course, the economic picture with jobless claims coming in this morning actually rising for the third straight week. I mean, you do start to wonder all the fears that we're talking about with regards to the macro picture certainly not getting better, at least on those reads.
With the tech names, you could argue that they've fallen so much. A lot of investors may be saying, well, these price points are actually not that bad. This is the time to buy the dip.